All right, everyone. So we're back. Mini series part 2. It's been a little bit of time. Been busy with some things. Actually having to deal with some clients, which is great. I've decided to do something different. Instead of doing a bunch of editing, I'm just going to do raw videos. I'm not good at editing. I'm not going to pretend that that's what's important. What's important really is the information. So if you're interested in learning a little bit more about how credit works, how to get a mortgage, your financing, how to get out of debt, that kind of stuff, follow along. I'm here to help. If you have any questions, leave them in the comments. Let's go. We're talking about credit. Now, I want my kids to know what credit is. A lot of people don't know what it is. And really all it is just expensive borrowing. And so a few recommendations I always make is, and I wish to make, and I hopefully younger kids and younger people getting into credit understand this, is you should have savings before you get credit. And why should you do that? Well, if you have a savings, a nest egg, say you got $3,000 saved up as an emergency fund in case things go wrong. Well, that $3,000 is going to allow you to buy tires if you need to. If you need food or you need some emergency things, you have the money saved to do it. What gets a lot of people in trouble is they get credit, so they get a credit card or something like that, but they don't have any savings. So when something comes up, they have to put it on the credit card, but they don't have savings to pay the credit card off. And that's where we get into this debt snowball, and it just starts accumulating and getting out of control for people. And then it finally gets to a point where they got to do something about it. So let's learn a little bit about credit and how it's derived, okay? So if we look here, there's 5 main components of a credit score. The first one, being the largest, is your repayment history. So do you pay your debt on time? If you have a credit card, you have a minimum amount that's due every month. Do you pay that on time, or are you consistently missing payments? That's going to equate to 35% of your overall score. Now let's remember this. Your credit score will range between 300 and 900, all right? Now, the lowest I've ever seen is in the 4s, and that was an absolutely terrible. So if you're in the 3s, you're doing something completely wrong, and you're really good at doing it wrong, all right? Now, I've only ever seen one credit score that was a 900. We call that a unicorn. Typically, a good credit score is anything over 680. When you get over 800, you're an exceptional credit score, all right? So the repayment history is 35% of your total credit score. The usage is 30%. And what is usage? Well, if you owe $5,000 on a credit card and the limit is $5,000, your usage is 100%. That does not look good, because what it looks like in a lender's eyes is that you're relying on credit versus savings. So that's called utilization. And if you have a lot of other credit cards that are racked up and are high on your limit to balance ratio, you're going to have a lower credit score, and potentially substantially. Now, the one benefit of this is if that's all that it is that you owe a lot of money on your credit cards, paying them down will increase your score quickly. And that'll be a lot quicker than if you miss payments. Missed payments will ruin your credit super, super fast, okay? So with your utilization or your usage, a rule of thumb, don't go over 50% of what your limit is. So if you have a $5,000 limit, don't go over $2,500. Now, why would you not want to do this? Banks and credit card companies, they don't report to your credit bureau every day. They don't do it every week. It's either done monthly, sometimes every 2 months, and sometimes quarterly. So if you, let's just say, racked up your debt in one day, and that's what banks will tell you, rack it up and pay it off. That's what helps you build your credit. That is the stupidest thing that you could ever do. Do not do that. It's terrible advice. All right? So if you get a credit card and you max it out, and even let's just say 2 days later you paid it off completely, well, if the next day after you maxed it out, that's when they report it, you could have nothing owing on it, but if you go try to get a mortgage, let's just say a couple weeks later, that will report as though you're maxed out, okay? So to make sure that you're always optimized between your high and low range of what your credit is, never go over 50%, okay? So do not exceed 50%. Okay? That is the biggest rule of thumb. Now, the third component of your credit is length. Now, the ladies out there know length is quite important, but the men typically don't. Now, is it as important as the repayment history and the usage? No, but it's still the third biggest component of your credit. So what that means is, how long have you had credit for? Did you just establish it last week? Or have you had credit for 5, 10 years? The more established your credit is, the more solid it is, the less volatile it becomes. All right. Now, the fourth one here is new credit. So are you applying for a lot of new credit in a short period of time? Let's just say a 6-month window and you've gone out and you've tried to get a vehicle, a holiday trailer, you've tried to get a bunch of credit cards, that kind of thing. That looks very negatively in your report and in lenders' eyes, because now you're actively seeking credit. Why are you seeking so much credit? What is going on? Okay, so that determines 10%. So if you're not really shopping around, your credit score is going to continue to climb and climb and climb. And the last one is your credit mix. So what types of credit do you have? So there's installment loans, and lenders love seeing these. So that's like a vehicle loan, a personal loan, something where the balance will change, but your payment does not change. Meaning no matter what the balance of the loan is, your payment is always the same every month. That's a recurring payment. That looks like a mortgage payment. So if you can manage those debts, that looks a lot better for you. There's also revolving credit, which is like a credit card or a line of credit, something that you can continually have access to when you pay it down. Those ones have a limit, so you shouldn't exceed that, right? But you can borrow and pay it off and borrow and pay it off. It's revolving, it's continuous. Then there's like department store financing, those kind of things. So your credit mix is really the last thing that kind of pulls it all together, which is another 10%. Now, if we're good at math here, we can see that that equals 100%. That's it. That's your credit rating. All right. So now, what are some recommendations I have, especially up here in the oil patch? And the biggest mistake I see a lot of people make is they do not automate their payments. Installment loans are always automated, so those are going to automatically come out of your account. But revolving debt is not. They send you a bill and you have to manually pay that bill. Same thing with your cell phone bill. You manually pay that. Now, when you get sent out to camp or maybe even go on vacation or potentially move and you're getting mailed your documents and your statements, I guess would be a better way to put it, that human error, you can miss payments, and the repayment history, again, 35%. So automate all your payments. And what I mean by that is set up your minimum payment to automatically be withdrawn from your bank account. Set up your cell phone so that it automatically comes out of your bank account. If you do that and it automates, that takes the human error out of it and you'll never miss a payment. And if there's a payment missed and you had the money in your account, you can go back to that and fight that and get them to totally redo it and fix it. And then that way it never reflects on your credit score in a negative way. So that's what credit is. It's borrowed money. Now, you can look at credit as like your job resume, all right? When you have a job and you're applying for a job, they want to know who's your previous employers. They want contact information. They want to find out how good you are of an employee. Did you show up late every day? Did you drink on the job? Were you hostile to other employees? Well, if you were, they're probably not going to hire you. Same thing here. Do you pay your bills on time? Are you showing up to pay the bills, basically, right? Are you managing the debt? Are you responsible with it? It gives the lender an idea of how you're going to manage the debt if you're trying to get a mortgage, all right? So that is the biggest thing. I don't know if there's too much more I want to get into on this video, but if you have any questions, please let me know. You can talk to me all you want. I'm never going to charge you for it. Just trying to get the information out there. If you find this helpful, please share it. Please recommend it to other people. And I hope this helped. As always, God bless.